Dear viewers, welcome to this episode of Expert Speaks. Q3 of financial year 23-24 is behind us. It's time to take stock of what happened in the last quarter. To know the answers, I spoke to fund manager Harini Dedhia on a conversation. So let's look into what she has to say about the quarter which has gone by. This is NRI Money Clinic for you, and I am Dr. Chandrakant Bhatt, your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
To take you through the scorecard of the Q3 FY 23-24, I spoke to Harini Dedhia. Harini Dedhia is a popular fund manager. The funds managed by her have got attractive ratings on CRISIL as well as the PMS Bazaar. She is the head of research and fund manager at Tamohara Wealth Manager. Let's listen to Harini Dedhia. Welcome to this episode, Harini Dedhia.
Thank you so much for the kind introduction, Dr. Bhatt. In our quarterly review edition this time around, we're not changing the format. We're staying consistent with what we've always spoken about. We'll briefly take a look at global macros and specifically then coming down to what Indian companies and Indian markets have done. And then we will also take a look at the sectoral views that we may have in the Indian markets. So without a further ado, I think we'll get started with our quarterly outlook on the global markets and Indian equity markets as well. I think just to take a look of how the macros have stacked up, I think we've seen a phenomenal rally especially led by the Magnificent Seven or the Fabulous Seven in the US, where we have the seven largest tech companies really leading the charge, and we've seen a stupendous performance of 20% plus on the S&P 500. Nasdaq itself obviously has done exceedingly well at returns of over 40% plus. We've seen stocks like Facebook, etc., do 150% plus returns in the last calendar year. We've seen inflation starting to get tamed in a way, and this has started reflecting in the US 10-year yields, which have cooled off back to the same levels where they were a year ago. Just 6 months back, I think that was not something anybody was predicting or had built in their estimates. The rupee also has been fairly stable at that 83 odd levels to the dollar. What has been surprising really in the entire macro setup has been the crude oil behavior. I think, given the escalation of hostilities and violence between Israel-Palestine and Israel-Hamas, to be specific, also to see how the Houthi rebels have behaved and started blockading the Red Sea passage for a lot of tankers and ships. One would have expected crude oil to be a little more volatile and on the higher end, on the higher side. We would have expected a lot more volatility, given that typically Middle East volatility is always linked with then crude oil getting volatile. And what this tells us is, the world's makeup of crude supply has really shifted. US has by far become the largest exporter of crude. Again, a reality that nobody would have expected about 5 years back. And that is really being reflected in the prices that we're seeing today. If I had to wager a guess on anything within the macros, I would say that we should potentially expect some volatility on crude oil front, given that we've seen one of the smaller nations already exit the OPEC, and we will see a little less coordination amongst the other crude producing nations than we've seen in the past. Nifty itself has done a fantastic run of 20 percentage points odd in the last year. And the forex reserves with RBI have also been stable, which is again reflected in the rupee being stable. On an average, there has been a marginal improvement in the average score that we've seen for BSE 200 companies. And when we see the earnings performance, I think that it gets reflected very, very well as to why this average score has improved. So now, diving straight into the earnings of Indian companies, Q2 earnings performance is what has gotten reflected in the stock prices. When markets rally the way they have in the last 6 months or it's very easy to say that, hey, the markets are very expensive and it's overheated and all of that. But if you see this market rally has come on the back of a strong earnings performance. The Nifty 50 has seen EBITDA growth of 21% and a PAT growth of 28%. And the BSE 500 or the NSE 500, which is a more broader set of companies, has seen a 29% EBITDA growth and a 40% PAT growth. Now, mind you, this has not come on the back of sales growth, right? As we've seen sales growth to be fairly tame, lower than real GDP in both cases. But it's come on the back of margin recovery. That's a theme that we've been speaking about for the last two quarterly webinars, and that's a theme that's been consistent. And in fact, where you see the Q2 performance of the indices, there's been a 10% outperformance since then of the Nifty. So since the end of quarter two, and then NSE 500 has performed to the tune of about 12-13% odd. So now it does seem like the stock performance has started completely marrying the earnings performance, and from here on we really don't see earnings having much scope to improve on the back of margins, right? Because your margins have started coming back to your all-time peak levels of 17.5, 18% odd. We've already breached 16.9% in the second quarter. So there is scope for some improvement, but not a lot. I think a lot of the heavy lifting now in terms of earnings performance would have to be done by sales. So the companies would really have to start seeing real growth, or sales, a volume-led growth, because inflation, has, like we mentioned, has also sort of been tamed in a manner. So we would have to see a real volume growth coming into these companies to see earnings performance from this point onwards. So this is when we would now start saying that, start looking at companies that have far greater visibility of volume growth coming in. For us, those would be companies that are linked to domestic consumption more than exports. There are a lot of factors still up in the air about exports performance, be it services or goods. But domestic consumption, one can be relatively more confident on. And, that is where we would want to sort of tilt our portfolios towards. And by domestic consumption, we're not referring to just consumer companies or retail companies or FMCG companies. I think what we mean is any business, even if it's a B2B company, an industrial company, but where the end product or the end user rather is sitting and enjoying growth in India. I think that's where we have far more visibility on. And going forward, we would be, cautious on trying to assume any multiple expansion from here on, or even margin expansion from here on. I think we would be far more comfortable only in those spaces where we see real volume growth kicking in. And while Indian markets have had a great run, the broader markets more so than the Nifty companies per se, I think it would be unfair to just sit and say that, we have really outperformed on a broader basis, or we've done very, very well. Because this is a part of a global rally that has happened in calendar year 2023. The best performing index, in fact, of 2023 has been the Karachi 100, surprisingly so, which is followed then by the Russian index. Then we have Nasdaq, Hungary, Turkey, Poland, Japan, UK, Taiwan, and so on and so forth. But right from Germany to Pakistan, in between, peppered with all sorts of countries, developed and developing both, all of them have outperformed the Indian stock market per se. So it's not out of tune. What the point we're trying to make is, beat on earnings performance, companies have delivered basis which the stocks have delivered, be it on relative to the rest of the world. It's not that India has outperformed in any shape or form. In fact, if anything, India has underperformed most of the market cap of the world in the last calendar year. So while we would be cautious given the valuation and overheating in some pockets, I think on a broader scale, we still won't be able to say that, Indian equities have topped out, and we're not calling for a massive correction in any which way. We would though say a view that we had started talking of in the last quarterly call, that going forward we would now probably see a little more of a time correction. But we still maintain our view that a price correction is unlikely given the reasons that we've discussed already. Now diving straight into the sectoral review, we will first take a look at four segments that have done exceedingly well in terms of stock prices: auto, capital goods, pharma, and real estate. And when we break down the earnings for this, we would see that capital goods is the real only anomaly that's there, because all the other three segments have actually seen a significant sales growth. Forget EBITDA and PAT growth, but the significant real sales growth or real volume growth coming in this year that we've not seen for a while in this sector, in these sectors rather. Capital goods is the anomaly where there's been a stupendous performance by the companies, but a lot of it is driven by the promise of a better future, because a lot of it is driven by the order book and the growth in order book for these companies, and not really in the actual delivery on that order book. So that's where we would be cautious going forward, and we would want to see a little more price correction over there coming in before we deploy more. And I think it's probably the sector that's most ripe for a price correction, if I had to say so. With auto, pharma, and real estate, given the performance that we've seen on sales, EBITDA, and PAT, I would not expect a significant correction coming in. And real estate companies, on an average, displaying a debt to equity of 0.6 is very healthy for the sector. This is one of the lowest debt to equity points that we've seen in this segment. So you've seen an acceleration of construction activity, acceleration of pre-sales activity in real estate companies, and all of that is still happening while the balance sheets are still fairly strong. So at this point of time, I think in all these three sectors, we would not be too concerned, and we would not want to proclaim that they're overheated in any which form or shape. I think if we still had to wager a guess, we would probably say that auto would be fairly valued, and it would be difficult for auto to outperform from this point onwards, because it's a cyclical industry that's seen two consequent years of good performance coming in, and probably we would see some cool off happening over there. Just to do a recap of what we had covered last time, we had spoken about banks in a positive tone on the valuation front, but advocating a shift to the stronger private bank franchises from PSU banks. Now, obviously, in the short term, it looks like we might have been too hasty on that front, but I think on the fundamental performance, it is true that stronger lending franchises, private franchises, are doing far better than PSU franchises. And in fact, we've already started seeing a NIM compression in the PSU banks, and we're likely to see a continuation of the same. In auto, our preference for auto AMFs over OEMs still remains, and the margins have normalized. So we were expecting a market return for autos. That has come through in the last quarter, and probably going forward, our view might be a little bit different now. In pharma, we still held the view that we've been speaking about for the last 3 quarters now. And in consumer, we spoke about luxury consumption as a structural play. Incrementally, our view is that in autos, cyclical volume recovery has come through. Like we said, we've had 2 consecutive good years, barring the two-wheeler segment. And margins have also come back to the mean level. So at this point of time, it would be very difficult for auto to now outperform the market. And I think large sides or large re-ratings have already happened. Should somebody still want to play this segment, auto ancillary is still the way to go. In banking, I think our view is that valuations are still reasonable, but we would now actively start pushing our incremental allocations to private franchises, stronger franchises than PSU banks going forward. And the one segment that we wanted to spotlight was real estate. I think real estate cycle has come out of the woods. It is typically what we've seen is real estate cycles in India. It's a good 5 to 6 year cycle, and we're probably 18-20 months into the cycle. There is volume growth across the country. It's not limited to a particular geography, right? From 14 to 22 odd, we probably saw volume growth in Bangalore, but we didn't really see it pan-India. Today, we're seeing volume growth in NCR, in Bombay, in Bangalore, in Hyderabad, in Chennai, all everywhere really. So I think that's something that's happening across. And I think there has been some price appreciation that we've seen in the last 18-20 months, which in real estate always garners more interest, right? It's not that higher prices actually pushes away demand. In fact, higher prices tempts more people into purchase cycles. So we still think that real estate has legs to run. Good quality developers are not livered as much as their own histories. And we've seen significant consolidation and cleanup also happen. So I think overall, on the supply side also, we're not seeing weaker players come out with a lot of supply, but it's been the stronger players who are coming out with more quality supply of township-led models than anything else. And we see demand for this kind of a product sustaining right for the time being. For us, though, because our focus has always been more on cash flows and consistent delivery on cash flows, we would prefer to play the real estate cycle via proxies such as paint ancillaries, cables and wires, cement, pipes, things like that. So we're incrementally allocating more money to these real estate proxies, so to speak. And that's where we would want to put some more money into. But that's pretty much the one, big area that we see that's not still being discussed and debated in as much detail, that we see some upside left in. But that has been our overall sort of take on the markets. We don't really like to categorize company by their market capitalization alone. It's unfair because we could have a mid-cap company that's actually a leader in its space and a large company in its space. So it could be a mature business, and a large cap company that's a very small percentage of the global market. So it could be still a growing business in the global context. But having said that, on the whole, if we had to generalize, we would say that India's, despite the stock market appreciation we've seen, I would not be comfortable calling for a price correction because one, we've underperformed a lot of global peers. Our markets rallying is a part of a global rally. It's not a standalone rally that has happened. And two, our underlying earnings performance of companies has been very strong. So a correction would come on the accord of valuations in certain spaces, but the growth visibility we think is still fairly high for a lot of companies, especially a lot of domestic oriented companies. So we would say that Indian markets are perhaps could head for a time correction, but not a price correction. We would say that on the whole, we are seeing more value in the large caps. But like I said, we don't prefer to categorize companies just on their market capitalization. But the larger companies today, the Nifty 50 today on the whole is more attractively valued than NSE or BSE 500 would be. In terms of sectors, real estate proxies is something that looks very interesting to us. Banking, we would advocate a shift to stronger lending, quality lending franchises now. It's not that valuations are uncomfortable. In fact, they're quite reasonable in this space, but still we believe that margins will correct from here on and credit costs will normalize, and we would want to now be with the stronger quality players. And pharma, our view sustains. There's nothing new we want to add, but I think our view sustains that the US price erosion has abated for the time being, and Indian companies are seeing a lot of new drug launches. So we're pretty sanguine on that, and that remains one of our higher allocations as a sector currently. That's it from our end on this quarterly update, and over to Dr. Bhatt. As always, thank you so much for having me on your show.
Thank you, Harini, for all these inputs from your side about what's happening in the Indian stock markets. We remain in gratitude to you for your kindness to spare your time for the benefit of my audience. Dear viewers, hope the episode that we have done today helped you to understand what happened in the stock market in the last 3 months. If it did give you a direction what you need to be doing in the following months, please do give me a thumbs up. If you are a viewer who is watching my channel for the first time, or if you are yet to subscribe for the channel, please hit that subscribe button and press the bell icon. Do not forget to share these videos with your friends and relatives, with your near and dear ones, and on all the WhatsApp groups on which you are connected with. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you with yet another episode of Expert Speaks next Tuesday. Till then, stay safe. Jai Bharat.
Press the bell icon for more details and subscribe our channel.